What is going on, guys? My name is Kian. Welcome back to my channel. Glad you're here to join us. Today we're going to be going over the financial steps, or the steps to take on your wealth building journey in order for you to exceed in your wealth creation. So these steps are not made for people who just want to live a boring, dull life. These are people who want to maximize their wealth building and really take that to the next level. Thanks for joining us. Let's get on into it. A quick disclaimer before we get started. If any of the steps mentioned in this video do not apply to you and your particular situation, you can just skip on over them and go to the next step. This list is to serve as just a checklist for you to check off boxes as you go along. So if a step doesn't apply to you, just skip it, go to the next one, move on. All right, let's get into it. Step number one of the financial steps is going to be get an income. So whether that be a job or a side hustle or a business or some freelance work you do in your free time, you have to earn some sort of income. This whole money equation, assets versus liabilities, income versus expenses, does not work unless you take in a number that is greater than zero.
Go home and get a job. Go home, get a job. Get a job.
So I like to think of it as you need a job that covers your basic life necessities. That's going to be your rent or your housing payment. That's going to be your transportation cost, your food, your utilities. You got to keep the lights on. So any of those payments, your income has to at least exceed that, plus be a little bit greater for you to have some extra to save up and invest, because that's, at the end of the day, how you make the real money. You need some spare income to be able to use to make more income and have that little snowball effect. So the first financial step, get a job. If you're young, just starting out, I know my first job when I was 16, 17 years old, I worked in the Walmart dairy section earning $12 an hour. And that was just how I got my start. You can do whatever you want. Just find something that you somewhat enjoy, something that doesn't make you want to pull your hair out, because you might have to be doing this for a little bit just to get your boots on the ground, get your feet wet a little bit, and start earning that income. If you're a little bit older and you still don't have enough money to cover the basic life necessities and a little extra to save and invest, then you got to find a way to get more income, whether that be doing a side hustle on the side or maybe get another job. I worked part-time as a Domino's delivery driver while I was going to school, so you could do that. You make pretty good money doing that. I know I was making like $30 an hour working in the Domino's in the city, so that was nice. Or maybe do something else, maybe start a side hustle. This YouTube channel is gonna be my side hustle. I'm just starting out. Please, if you are enjoying the videos, please leave a like, subscribe. It really helps me out. I'm trying to do the same thing that I'm gonna preach to you guys, so maybe we can help each other out here. All right, on to the next step. Step number 2 on the financial steps journey is gonna be to get your employer 401k contribution match, if this applies to you. So I know at my company, they offer a 401k match, and I'm absolutely taking advantage of that. Your 401k match quite literally is the only time in your entire life you are going to be guaranteed a 100% return on investment as soon as you put it in. It is instant, because whatever you put in, your employer is going to match that up to a certain amount. So this is not free money, it's not a glitch, but your employers most of the time will offer this, and if you are not taking advantage of it, you are leaving money on the table, and you do not want to be doing that. Now, this 401k match, again, is 100% return on investment. So even if, say, you have a credit card that you have some debt on and you are paying 25% APR on that credit card debt, it is still better to get this 401k match, because your money is instantly doubling with no questions asked. So 100% return on investment, much better than that 25% or even 30% in extreme cases that credit cards may charge you. I would recommend getting this 401k match first and then moving on to the next steps. So an example from my life right now, my company is currently doing a dollar for dollar match up to the first 3% of the income that I contribute into my 401k. And then for the next 3%, they're doing a 50% match, which is 50 cents on the dollar. So for every $100 I invest, they'll put in 50 of their own money into my account. And now that money will be completely in my name. And now I have that as long as you're vested. So the little quirk here is that sometimes, I know in my case, my company does not offer a match until you've been with them for at least a year. and then that match does not get vested then until you've been there for 2 years. So after the first year, the employer is going to start putting money into your account, and it'll be like this little subcategory. And then after your second year you've been with them, it'll be now completely your money, which is called it's being vested. So now it's your money in your name. They can no longer take it away from you if you decide to quit and move jobs. Now, I recommend at this stage in the financial steps that you only contribute up to the max amount into your 401k that your employer is going to match. So in my case, the first 3% they match dollar for dollar. The next 3% they match 50 cents on the dollar. For a total of 6% of my annual income, they will match and give me free money on the side. So I am only going to put in 6% of my total annual income into my 401k, get that match, and then I'm going to move on to the next steps. And then later in the financial steps, as you'll see, we can come back to the 401k and add more later if that is what you want to do. All right, step number 3 in the financial steps, after you have an income now and you've gotten your employer match on your 401k, I want you to save $2,000 into a savings account, preferably a high yield savings account, as an emergency fund. This will keep your head above the water if anything comes up that you need to pay for out of pocket, maybe like a surprise medical bill, or like you break your phone, you got to get a new one. You won't have to put these charges on a credit card, but instead you'll have that cash saved so that you won't go into further debt further down the line if something like that comes up. Now, I came up with $2,000 because it piggybacks off of Dave Ramsey's number 1 in his baby step plan, which is save $1,000 into an emergency fund. But since he made those baby steps back in the mid 1990s, and now it's 2023, and $100 back then is equivalent to $200 today.
It's nuts. Okay.
I've even said that. I was like, no, this isn't right.
I know. This is nuts.
I just doubled it to 2,000 to keep up with our good friend inflation, which now all of us know very well. It's on the news everywhere. Good old inflation. But that's how I came up with the $2,000. It's a little bit of a cushion to help you out. I really love Dave Ramsey's approach to why he made this, because $2,000 or $1,000 in his case is not going to be enough to cover every emergency expense that you're going to come across. Maybe your car needs new tires and needs an oil change and needs a new engine. Your car just breaks down.
Oh, no, I cannot afford this right now.
Maybe it's just something minor.
$2,000 is most of the time not going to cover that entire expense. Or maybe a surprise medical bill comes up and $2,000 doesn't cover all your deductibles. But it's not meant to be an end-all, be-all. This is going to cover me every single thing. This $2,000 is meant to be a little cushion in case you get in some tricky waters, but it's meant for you to know that it's not enough so that you'll complete the next steps faster, and then you can go and boost your emergency fund, which will be later in the financial steps. Step number 4 of the financial steps is going to be pay off all of your high interest rate debt. Now, high interest rate debt is going to be categorized as anything over 8% interest on a debt payment. You're going to want to pay that off, and you're going to want to pay that off fast. You can think of this debt payment sort of like getting a guaranteed 8% interest on your money every single payment that you make. So say you have a credit card that's charging you 12 to 15% interest each month. If you pay that, now you're not going to have to pay the interest on the money you put to pay for that debt, because you're not going to be accruing extra interest on top of that because you'll be paying down that principal amount. This step is made to relieve some of the stress on your monthly income and some of the stress on your daily life. Not having that high interest rate debt slowing you down and taking money from your paycheck each and every month is going to just accelerate your wealth building journey in the later years, and you're not going to have to deal with those pesky large numbers that just increase every single month. If you're only making the minimum payments, you are losing money and net worth every single month, because these debt payments and these interest rates that we are seeing nowadays are just extraordinarily high. Like, I've never seen interest rates this high in my entire life. So you need to be focusing on paying off this debt. It is a massive drag to your wealth building journey. This step's really about being in control of your money and not having your money and your debt control you. You don't want to be dragging around what feels like hundreds of pounds of weight while you're trying to walk up the stairs, is a good analogy that I would compare this to.
I was wrong, and so as punishment, I am forced to carry these heavy chains through eternity.
Your debt is dragging you down that much, and some people don't even notice that. You just have constant debt payments that are just coming out of your paycheck, and people just pay it off like it's clockwork, and people think that this is going to be my way of life for the next 30 years, which it does not have to be. You can slowly make payments on this debt and get rid of it, and then you just watch and wait and see just how great your net worth is going to explode after you get rid of these debt payments. Your income is going to just be so freed up that you can finally live life the way you want to live life because you have so many more opportunities with your money. For debt that's below 8% interest, you don't have to hurry up to pay that off right away. Instead, you can keep that debt, slowly make the payments on it, and then invest that extra income that you would be using to pay off that debt, because the S&P 500 over the last entire lifetime that it's been open has averaged about 11.5% annually. So you don't have to always pay off your debt. You can keep some of that lower interest rate debt. Mainly your mortgage is going to be below 8%. You can keep that debt because that's not horrible debt. You can slowly make those payments and then really put that rest of that money to work in the stock market or other investments that earn a little bit higher interest rate. Okay, so how do you pay off this debt? There are two main methods that one I like a little bit more than the other, and both of them have to deal with snow. Don't know why, just how it is. One is called the debt snowball, loved and adored by all the Dave Ramsey fans. This is the plan that he recommends. And then the plan that I recommend, just because I'm more analytical, I like numbers, is the debt avalanche method. And the difference between the two is just how you pay off, the order in which you pay off your debts. The debt snowball method works by listing all of your debts in order from smallest balance to largest balance, and then starting paying all of your extra debt payments into your smallest balance amount. So say you have like $1,000 credit bill, and then you've got like a couple other credit cards that are slightly higher, and then your mortgage is at the bottom, and maybe your student loans are down there too. You would start at that small $1,000 credit card because you'll be able to pay that off super quickly, and then you'll get that little boost of encouragement because you're making progress towards your debt payment, and you'll be able to see that visually. You'll be knocking things off the list, you'll be able to check that box, and then you'll move on to the next one. So this really helps people stay disciplined, stay at it. And I like it if you're not gonna be all goody two shoes. You're not going to be going and attacking this debt like your life depends on it, and you really need that little extra encouragement. This method's for you. I recommend it. It's proven to work. Dave Ramsey fans love it. It's worked for them. So if this is the one that you want to do, by all means, go for it. The debt avalanche method, on the other hand, is sort of similar, but you'll be listing your debts in order from highest interest rate to lowest interest rate on your debt, and then you'll start paying all of your debt payments on that highest interest rate loan. So maybe your credit cards will have the highest interest rate and your mortgage will have the lowest interest rate. You'll be paying that highest interest rate first, because the principle behind the debt avalanche is in the end, you will be paying the least amount of money in interest, because you'll be paying the debt that has the most interest accrued every single month. So you'll pay off the high interest rate debt. That won't be able to come back and accrue more interest very rapidly. It won't have that 25% interest rate that some credit cards have. And then once that's gone, you'll move to the next highest interest rate. And in the end, you're going to be paying less money than the debt snowball method. But sometimes those high interest rate payments are much larger. So it might take you longer to see some actual progress, but in the end, you'll pay less money. So this is the method that I like. If you're analytical and you're disciplined and you're actually gonna stick to it without needing those little progress boosts along the way, this is the one I recommend. It will save you more money. All right, let's move on. Actually, one disclaimer before we move on to the next step. Now that you're out of debt in this step, you're paid off all that high interest rate debt, that bad debt, most of it probably is credit cards or student loans. Stay out of debt. You do not need debt in your life that's bad debt. Some debt is good. If you want to get a rental property and a mortgage on that, by all means go do it. That's what I'm gonna do. But this bad debt, this credit card debt is awful. Stay out of it. You've done so well so far to get out of it. Now stay out of it. You can do it. All right, now let's move on. Step number 5 in the financial steps is going to be going back to your emergency fund and boosting it up a little bit and adding a little bit more cushion so you feel a little bit more comfortable. And now I recommend you having your emergency fund anywhere between 3 and 9 months of expenses. So if you don't know how much money you spend in a month, this is a perfect time to start tracking your expenses each and every month, and then take the average and see how much am I spending each month, and then multiply that by whatever you need to feel comfortable. I recommend that maybe if you have like a government job and you have a stable income, you get paid the same amount every month, and you know when your next paycheck's coming in, your job is very stable, you're not gonna lose it, nothing unexpected is probably gonna happen. Now, I know there's those black swan events every once in a while, but if you have a stable income, you can be further down towards that 3 months of expenses in your emergency fund. And then say you have a job that you work just off of commission, maybe you're a salesman, maybe you are a real estate agent. If you don't know when your next paycheck's gonna come in, you're gonna wanna gravitate towards that 9 months of expenses, because you're gonna need to be able to weather that storm in the case that you can't find a house to sell for multiple months in a row. You're gonna need that emergency fund built up to make sure you don't put yourself in more debt and you don't have to rely on credit cards to be able to get through this. So now this is the point. After you've paid off your debt, you can go back, boost your emergency fund up, and you want to do this so you feel comfortable. You can weather whatever storms, and because life happens, man. I know, been there. Don't go into more debt. Have an emergency fund set up to help you with that.
Yep. I said it before and I'll say it again. Life moves pretty fast. You don't stop and look around once in a while, you could miss it.
Step number 6 of the financial steps is going to be maxing out your Roth IRA. Now, the Roth IRA is hands down the best retirement account that is available to you. The benefit of the Roth IRA is the fact that whatever money you put in there, you put in post-tax, and then whatever money you have in there will grow tax-free. So what this means is when you get your paycheck from your job, taxes have already been taken out of that money. Now you can contribute that post-tax money into this Roth IRA, $6,500 per year, and then that money will grow because you'll invest it. And then when you hit the age of retirement and you take that money out, you will not be taxed on any of the gains that you've made within that account. Now, I'm gonna make a video about Roth IRAs and all the quirks and ins and outs of it, so I won't go too into depth. But for the money that you put into your Roth IRA, if you're young, I recommend putting 100% of that money just into an S&P 500 index fund, and then forgetting about that money, doing that every single year, maxing that out, investing into S&P 500 index, and then just forgetting about it and let that grow. And then once you hit retirement and you wanna take that money out, you'll be surprised. You'll be happy you did this step. Step number 7 in the financial steps is now flexible investing. So the number that I recommend is that you should be investing bare minimum 25% of your annual income. A lot of experts out there say that you only need to invest 10%, 15%, even 20%, some people. But if you want to be exceeding expectations, and if you want to have actual wealth and you want to build something, you need to be investing bare minimum 25%, no questions asked. Investing 10 to 15%, yeah, it will get you somewhere. You'll have enough money to live in retirement, but you will not have excess. You will not be able to live a life that you want to live. You won't have that freedom to choose. So 25% bare minimum. If you want to do more than that, more power to you. If you can do more than that, that's great. That's what I'm going to be doing. I'm going to be trying to invest near 50, maybe over 50% of my income, because I want to really be out there. I want to exceed the average American. So 25%. Now, what to invest 25% of your income in? You have some options. So option number 1 is to go back to your employer-sponsored 401k plan and go and max that out. You are able to contribute $22,500 into this 401k. So whatever you put in before, you got that employer match if your employer offers one. Also, if your employer doesn't offer a 401k, just wait for later options. But if your employer does offer one, you can go back into that and contribute to max that out too, because this is also a tax advantage account, a little bit different than a Roth IRA. This is pre-tax money that you invest, so you can write that money off that you invest into your 401k from your taxes, and then you won't be taxed on that money. Only quirk is when you take it out in retirement, you will be charged income tax on whatever money you pull out. So if you pull out $80,000 in a year in retirement, that will count as income, and you will be charged with the federal and state income taxes on that, which could be a lot of money. But since you're able to put it in tax-free, you won't be taxed before. It's a tax advantage account. I recommend you do that. It's better than being taxed on both ends, pre and post. So that is your first option. Go back, max that out. Now, if you still haven't hit your 25% after doing that, you can go to option 2 of your flexible investing is going to be opening up a brokerage account and then either investing in more index funds, maybe an S&P 500 index, or you can play around with individual stocks. Now, do not be stupid. This is where a lot of people lose money. I don't recommend going and putting all your money into GameStop or some random penny stocks or some stupid crypto that'll go down. I like crypto, but stick with the big guns. Stick with the big companies. Diversify a little bit. Don't put all your eggs into one basket. If you want to put some money into Apple, or you want to put some money into Tesla, or maybe some money into NEO and you want to gamble a little bit, do not lose this money. This is investing, not gambling. You want to make money on this. Stick with the big guns. I recommend just doing more index fund investing. It's going to be your best bet. You are almost guaranteed to make money in index investing. It's free money. Don't lose money, but if you want to have some fun, this is your chance to do so. Or you can go to option 3 is the option that I enjoy most. This is the one that I'm going to be doing, which is saving that money in a high yield savings account. Now, what are you saving it for? A down payment on a rental property, or just a house. Maybe you want to save for a house. This is your chance to do so. You can put money into a high yield savings account and then look for possible rental properties that come up, and then you'll be able to afford that down payment and you'll be ready to do so when the perfect deal pops up. So this is what I'm going to be doing. So I'll keep you guys up to date on how my journey goes, but this is also an option for those of you who want to dabble in the real estate realm, maybe become a landlord and start getting some rental income. This is your third option. Now, step 8, the final step into the financial steps, is going to be enjoy. You have to enjoy the income and the money that you make. Otherwise, what's the point of money? Just to look at another zero in your bank account? You want to make money to enjoy the freedom, to live life on your own terms, yes, of course, but you also want to enjoy that money. You've worked hard for it. This is your time to live, right? You don't want to be all cooped up, in your basement, saving every single dollar you can. That's not healthy for you. You need to be able to live your life. Now, a little disclaimer I have to throw in there before we end the video is that you need to be smart about this part. Don't go and blow all your money on Gucci flip-flops and airplane ticket to here and airplane ticket to that and buying every single mountain under the sun, because every dollar you make when you're 20 years old and that you spend could be worth $88 in 45 years when you retire. So just let that sink in before you go and blow all your money on these random items. This is money that could be used to benefit your future. I do want you to enjoy your money, but you have to be able to value your money and your time. So don't go crazy, be smart, have fun. Thank you guys for watching. I'll catch you in the next one. Peace out.